We are going to explore all the angles of investing in the US market, specifically to diversify or to add that touch of diversification in your portfolio. So currently, just explain us how exactly are the US equity market placed?
Yeah. So, Kavita, I think that we're having this conversation at a very good juncture. Obviously, I think we've been very strong proponents of international diversification. And let me just, quickly, to address your question about, where the US market's placed, right? So there have obviously been, headwinds for the US markets given, where, the economy is headed, with inflation concerns, Fed hiking aggressively. But what we've seen in the past 1 year that, in 2022, especially calendar year 22, there was a sharp drop in the US equity markets. And obviously, relative the Indian equity markets did outperform. In the last 3 months, the first 3 months of 2023, there has been a recovery in the US markets, especially on the technology, sort of, some of the communication, media, entertainment names. But that valuation gap still still exists. So I think broadly, I mean, the US markets are obviously poised at a very interesting juncture with, I mean, there are clearly some headwinds in the short term. But I think the overall thesis when we think about investing in a market like the US, that still remains intact over the long term. And we can kind of discuss that through the show.
Kaustubh, also explain us when we talk about international exposure to your portfolio or maybe diversification of that type, why should we consider only US markets at the current juncture?
So I wouldn't say it's necessarily a case only for the US markets. But when you think about just the options that are available to an Indian investor right now, especially through a India domiciled fund route, a majority of them are sort of US based. That's one, obviously. And I think secondly, I think US markets being the world's largest economy, being home to some of the largest corporations, global corporations, the most innovative corporations around, definitely makes a compelling case to have allocations towards US equities. You can definitely look at other markets across the globe, but I think US markets definitely, from a long-term perspective, an Indian equity investor should be looking to allocate some of his or her capital towards that. And let me just outline some of the reasons that I kind of alluded to, right? So, like I said, some of the largest corporations in the world that reside in India, in the US. And remember that these are corporations that don't have business only in the US. They have businesses all across the globe. And, if I just give you some quick stats, and everyone talks about these global corporations, which is some quick stats around when you look at the large benchmark indices, be it the NASDAQ 100 or the S&P 500. From the NASDAQ, only about 50% of the total revenue of the NASDAQ 100 companies actually comes from the US, right? The remaining comes from outside the US, so truly global, and, even in their revenue spread. So you're getting exposure to a corporation that has revenues coming from all across the globe. In fact, India accounts for about 1.5% of the overall sort of revenue coming in for the NASDAQ 100 companies. Similar stats for the S&P 500, probably slightly more, US centric given the spread of the companies that are available. About 60% comes from US revenues, but the remaining 40 comes from outside, and about 1.5% again coming from India. So I think these are all brands and companies of which products and services we are very well acquainted with, right? So why not participate in the growth of these companies, which are really leading edge, cutting edge in terms of their innovation and coming in products and services, which an Indian investor otherwise would not have access to necessarily from a local market context. So I think that adds a lot of value to your portfolio, in terms of, so we speak about diversification. Here's a diversification that, can happen in terms of company type, product type, obviously geographical diversification, because the other thing that, has played out in the past, if you just look at calendar year returns of say Indian equities versus US equities and some of the other international markets, they always work in tandem, right? So there'll be years where Indian equities, for instance, 2022 was a classic case in point where Indian equities did relatively much better than US equities. But if I just take it back in time to the years of 2019, 20, 21, especially 19 and 20, US equities significantly outperformed Indian equities, right? So you need to be invested in those markets to make the most of it when the run up happens again. And that's where you can really aid in diversifying your portfolio, not just typically by asset class or by market capitalization, but by geography of the businesses that you're kind of investing in.
Sure. So this diversification should be like a broad-based diversification, or we can also take a thematic route when it comes to international exposure and specifically US equities.
Yeah, I would think it would I would lean towards taking a more broad-based diversification. For most investors, that would probably be the ideal route. So typically your more broader indices would, have a good representation of, the largest companies, like I said, which are US domiciled, but, have operations all across the globe, right? So, and there are two primary indices that, people track. Obviously, there's the NASDAQ 100, which is typically overweighted more towards sort of the technology communication services names, so it doesn't have any financials exposure. Or you have your S&P 500, which also includes your financial exposure within that broad-based so these are the two broad US indices that investors can look at. And obviously, there are options available to them across both of these. I think thematics would only be useful for an investor who wants to express a certain view, that who's very, very positive, say, on a certain set of stocks, or more pro value or growth. If you want to do a style-based diversification, would look to expose themselves to that. Otherwise, I think a broad-based would work best for most investors.
How can one capitalize on the currency hedge here?
So, this is something that people, do kind of replicate. So remember, your investments, when you're eventually, investing in a fund, while it's rupee denominated, the end investment that the fund is making is either into, US stocks or a US based ETF or a fund, which is obviously US denominated, right? And essentially what happens is, your end investment is actually US dollar denominated. And, given traditionally we've obviously been, high growth, high inflationary economy with higher interest rates, the rupee has depreciated against the US dollar. And obviously, as, US inflation and interest rates kind of normalize over the years, the rupee could tend to, that's what macroeconomics suggests, to continue to kind of, depreciate versus the US dollar. So what that does is then will essentially allow you to take a US dollar exposure, which could also help you in kind of getting some currency appreciation. While that's not the primary motive, but, a lot of people, say, for instance, have goals for their children or whatever to say study overseas. And we've all faced the brunt of it, that costs of education are going up. With a depreciating rupee, the cost of education get exacerbated even more. Here is an investment where, not only will it benefit from the fundamentals of the US economy, but also perhaps, just from the rupee depreciation that could play out over the coming years.
One question, that's coming on my mind is, since we all know that in a globalized world, economies are really connected with each other. So when we talk about international diversification, is it really diversification in its true sense? And for that matter, US equities?
Yeah, absolutely. So I think that's a very good point, Kavita, because, we always imagine that, we are one global pool of assets, and, that's how economies are definitely going to be, kind of not necessarily moving in tandem, but taking a cue from each other. But markets always can move in dissonance, right? And that's actually what we've seen in the past, and we expect that to continue to play out. And if you just look at, and for convenience, we've kind of broken it down into, say, calendar year returns of the broader Indian indices versus the two frontline US indices that we spoke about. And we've seen pockets of time, I alluded to that in the earlier sort of discussion also, that 2019 and 20 were great years for the US, sort of markets versus relatively to the Indian markets, right? In fact, 2020 is a specific case in point where the tech stocks did exceedingly well. The NASDAQ 100 was almost up 50% versus maybe about 16 to 20% for the Indian indices. The S&P 500, probably not so much. It was only up about 18, 20%. But 2019, we had both of these indices up between 30 to 40%, whereas the local markets were only up 10, 12%, right? We know that changed in 2022. We've seen this in the past also. 2013, let me take you back 10 years. 2013 was another classic case in point where the dispersion of returns was massive between the Indian markets and the US markets. The US markets, both these indices were 30% plus for that calendar year in 2013, whereas the local Indian markets were in single digits, about 6 to 7%. And this completely flipped in 2014, where, obviously post the election results, the Indian markets ran up, while the US markets posted reasonable returns of high teens. The Indian markets are about 35, 40% up, right? So this interplay of market movement continues to happen, obviously depending on where people see valuations